Hello. Welcome to our next chapter, that is your import and export. So first we will be covering the import part, then we'll be doing the export part. Starting with import, of course, I hope everybody knows the meaning. That is when goods or services comes in India. So first is import of goods. There are different things. One is your warehouse goods. What are warehouse goods? For example, this is your south border of India. Okay, goods come by ship. Goods come by ship into India now. In the coast of India, wherever goods are, wherever we have custom ports, over there we also have warehouses, because at times what may happen, an importer might import goods in India, but not for home consumption in India. That means he does not plan to sell those goods within India. He plans to get them to India and then again sell it to some other person outside India. So in such a case, what does he do? He keeps the goods in your warehouse. Now these are not normal warehouse; these are your custom warehouses. So he will keep these goods at warehouses, and therefore he does not have to pay tax because the consumption is not in India. These goods again go outside India. So therefore these are called your warehouse goods. So these will be at your border only somewhere. They will be at some port. So GST is not leviable when goods are deposited in custom bonded warehouse. That because goods are right now, even though they are inside India, they are physically inside India, but they are not cleared for home consumption. Therefore, it cannot be sold in India. So therefore, deposited in custom bonded warehouse are sold before clearance. So before clearance means clearance for home consumption. That means clearance to come inside India. That means if they are sold before this clearance is given, GST will not be leviable. Leviable when X bond bill of entry is filed for clearing such warehouse goods for home consumption. So only and only when you clear these goods for home consumption, that is home is your India. Only and only in such a case will GST be leviable. Okay, now what will be the amount? So the value on which GST will be levied will be higher of your transaction value. Because what if this good has been sold in within the custom warehouse only, it has been sold multiple times. So in such a case, it will be a transaction value, that is the last value if there have been multiple transactions. Or your value at the time of filing of bill of entry plus your basic custom duty, whichever is higher, that will be considered as value for levying your GST. This was your warehouse goods. Next is your taxability of high sea sale. Taxability of high sea sale means if goods are coming by ship and the document your before the goods have come to India, you have already sold the goods. You have already given the document to someone else that boss, this is yours, you give me the money. When the goods come in India, these goods are yours, do what you want to. So you have sold the goods while they are in transit, while they are in the ship, while they are in the high sea, that is the sea itself. So in such a case, your value will be the price paid by the last high sea buyer, that is whoever is the last buyer, whatever price he has paid, that will be the value. Then next is your third country shipments. Third country shipments is, suppose A from India buys from Dubai. So now goods are coming from Dubai to India and sells to Sri Lanka without goods entering India. The goods never came to India. What did he do? What did he do? He buys from Dubai and sells to Sri Lanka. So when he has bought from Dubai, he directly tells the Dubai person that boss, I want to buy goods, but don't send the goods to India, send them directly to Sri Lanka. That is your bill to ship to model. So he buys from Dubai and sells to Sri Lanka without goods entering India. There will be no GST or customs because the goods were never cleared for home consumption. GST or your customs will only and only be leviable when goods have been cleared for home consumption. Next is goods imported by a SEZ, that is your special economic zone. So it will be exempted, there will be no GST. And next, last under your goods is goods imported by 100% EOU, that is your export oriented unit. So it will be exempt up to 31st March 2022. Now coming to your next part, that is of services. So of services, if your supplier is outside India and recipient and place of supply is in India, that means when is it considered as import of service? That is only when your supplier is outside India and your recipient and your place of supply both have to be in India, only then it will be considered as import of services. So your OIDAR services, that is your online information database access and retrieval service. Online information database access and retrieval. So for example, your Netflix. Your Netflix holds some movies in its database which you want to access. So it's mediated by IT over the internet. Okay, so it is mediated by information technology. This service is only possible because of information and technology. These services are automated and impossible to ensure in the absence of IT. So there is one question because where they make you identify that, boss, tell us, is this an OIDAR service or not? So please solve your question, minds. Example, a PDF document which is manually emailed by your provider is not OIDAR. So when you purchase my soft copy notes, I manually send you the soft copy. It is not an automated process. So therefore, this PDF document that I'm manually selling, this is not your OIDAR service because I am manually doing it. This is not automated by IT. Okay. So your supplier pays to government. So of course, now there are two types of charge. One is your forward charge and one is your reverse charge. So I think the words have been missed over here. Okay, so when your recipient pays to the government, it is your reverse charge, and your supplier pays to the government, it is your forward charge. So under forward charge, your supplier is outside India and recipient is in India, but your recipient is not registered. Recipient is not registered, therefore, in this case, the supplier will pay to the government. That means the person who is providing the OIDAR service, he will pay to the government because my recipient is not registered. And supplier and recipient both in India. So in both these cases, it is under forward charge. So either supplier and recipient both are in India, or supplier is outside India, but recipient in India is not registered. However, if supplier is outside India and recipient in India is registered, in such a case, it will be under reverse charge mechanism. That is, the recipient will be the paying type. That is the person who is using OIDAR service, this registered person, he will be liable to pay tax to the government because this is under reverse charge. So for those of you who are watching the video and you have these words missing, please write down over here. This is your forward charge and this one is your reverse charge. Okay, so how I had learned it in my time is R for recipient, R for reverse charge. That is, recipient pays to the government, so it is your reverse charge. Okay, so this was your import of goods and services, nothing very complicated. Now we are coming to your export of goods. So export is when goods travel beyond your 200 nautical miles from the baseline. So your baseline of India, from if they travel outside this area of 200 nautical miles, then in such a case, it will be considered that goods have been exported. Outside India and to SEZ are zero rated supplies. This means full ITC will be available on input. So as we've already studied what zero rated supply means. What is the difference between zero rated, nil rated, exempt supplies? Okay. So your zero rated supplies, even though no GST is leviable, you will still get ITC on your inputs. This is not the case with exempt goods because in case of exempt goods, you are not paying any GST on output, but you are also not receiving any ITC on your inputs. However, in zero rated supplies, you get ITC on your inputs as well. So therefore, full ITC will be available on inputs as well. You can claim refund using either of the following options because what happens, you are exporting, you are not collecting any tax, but your goods that you are using to make these, that is the inputs, you are still paying tax on those now. So how this ITC that you are getting, there is no way to utilize this ITC. So how do you get this? So therefore, there are two options. First option is supply goods or services under bond or letter of undertaking. LOU stands for letter of undertaking without paying IGST and claim unutilized ITC as refund. So this is when you enter into a LOU. Or yes, second is supply goods and services on payment of IGST and claim refund of such tax paid. So what was your first case? Your first case means you do not pay IGST at all. You already sign a letter of undertaking, and from whoever you are purchasing, you show them this letter that, boss, you do not have to charge me any tax. So this is your letter of undertaking without paying any IGST. And second is you pay that person IGST, you do everything, and then you claim refund from the government and, boss, I had paid this amount. Please give this back to me. Now what happened in this case? your capital gets blocked, because anything that you are purchasing for 100 rupees, you will actually spend 118 rupees in cash. And this 18 rupees you will get next month when you file your return, and you get your refund even after that. So therefore, if you already sign an LOU, you will be saving on this whole hassle of paying 18 rupees as tax, then again receiving a refund, filing your returns, everything that is not needed. Now, there are some certain deemed exports which is only for supply of goods. Okay. So, if it is by a registered person against advance authorization, or if it is of capital goods by a registered person against your EPCG authorization. So, I am aware, I hope everybody of you knows the EPCG scheme, or if it is by a registered person to a export oriented unit. So these are normal supplies which are usually wouldn't be considered as exports, but these will be deemed exports. So if any, it is by registered person against advance authorization, that is your AA. If it is capital goods by a registered person against EPCG authorization, next is by a registered person to an export oriented unit, or and if it is gold by a specified bank or PSU, in such a case, these will be considered as deemed to be exported. So taxability, your deemed export are not zero rated, because zero rated are different. All supplies notified as a supply All supplies notified as a supply for deemed exports are subject to taxes. Refund of tax paid on supply regarded as deemed export is admissible either to the supplier or recipient. Okay, so either the supplier will take it or the recipient will take, either of them will be allowed to take it. Now, next is your merchant export, that is export through third parties. So, in such case, what happens? There is an Indian manufacturer. There is an Indian manufacturer which over here we will call as IM. Now, he sells goods. He sells goods and charges GST at the rate of 0.1%. This Indian manufacturer, he may not be knowing that what all are export, what conditions they have to do, what all formality they have to do. He does not know. So, what does he do? He sells it to a third party. Over here your third party is your merchant exporter, that is your ME. So what does he do? The manufacturer says that, boss, I only know how to manufacture goods, you know more about export, so I will sell the goods to you and then you export it outside. So in such a case, what does he do? He sells the goods to the merchant exporter, that is he sells the goods to ME and charges GST at the rate of 0.1%. Now this merchant exporter exports these goods within 90 days to outside India. Within 90 days from this transaction, he sells those outside India. Now, in such a case, what you have to understand, your merchant exporter shall get credit of 0.1% of GST paid, because he has paid GST to the Indian manufacturer. He has paid GST, so he will get credit of 0.1%. Your IM, that is your Indian manufacturer, gets a refund of ITC minus your inverted duty structure. I hope all of you, since you are watching these revision videos, you would be knowing what inverted duty structure is. And next is your merchant exporter can only export under your letter of undertaking or bond. He will have a letter of undertaking bond, only then he will be allowed to export. Okay, and with this, we are done with this chapter, and I'll see you in the next one, that is refunds of GST.